Imagine a life with financial security where your money works for you, growing steadily over time. Investing in the stock market allows you to become a part owner of successful companies, participating in their growth and profitability. This beginner's guide will equip you with the essential information and strategies to take those first steps towards financial empowerment. We'll demystify the jargon, break down complex concepts, and provide you with a clear roadmap to begin your investment journey. Remember, the journey of 1,000 miles begins with a single step, and your journey to financial freedom starts right here. The stock market is often seen as a complex and intimidating realm, but at its core, it's a platform for growth and opportunity. It's a marketplace where buyers and sellers come together to trade shares of publicly listed companies. These shares represent ownership stakes in those companies, and when you buy a share, you're essentially buying a small piece of that company's future. As the company grows and becomes more profitable, the value of your shares is likely to increase, allowing you to participate in that success. While there are risks involved in any investment, the stock market has historically provided investors with the potential for significant returns over the long term. Navigating the stock market can seem overwhelming for beginners, but this guide will serve as your compass, providing clear directions and practical advice. You'll learn about different types of orders, how to read stock quotes, and understand the factors that influence stock prices. We'll cover the basics of fundamental analysis, where you'll learn to evaluate a company's financial health, management team, and competitive position. Risk management is paramount in the stock market and will equip you with strategies to protect your investments and minimize potential losses. Remember, knowledge is power, and by understanding the fundamentals of the stock market, you'll be empowered to make informed decisions and embark on your investment journey with confidence. Embarking on your investment journey in the Indian stock market requires a basic understanding of the key players and mechanisms involved. At the heart of this ecosystem lies the demat account, your gateway to owning shares of listed companies in India. But before you can begin trading, you'll need a trading account, your interface to the stock exchanges. This account acts as a bridge, connecting you to the bustling marketplace where buyers and sellers converge to trade shares. By the end of this section, you'll be well equipped to take those crucial first steps towards becoming an investor in the Indian stock market. Section 2. Demat account, your gateway to ownership. The demat account, short for dematerialized account, has revolutionized the way shares are held and traded in India. When you purchase shares through your trading account, they are credited directly to your demat account, reflecting your ownership in the respective companies. Conversely, when you sell shares, they are debited from your demat account, seamlessly transferring ownership to the buyer. To open a demat account, you'll need to choose a depository participant, DP, typically offered by banks or financial institutions. Open your demat account with link in caption. Section 3. Trading account, executing your investment strategy. While the demat account serves as the custodian of your shares, the trading account is where the action unfolds. It's your command center for participating in the stock market, allowing you to buy and sell shares, track market movements, and manage your investment portfolio. You can place different types of orders, set price alerts, monitor your holdings, and access research reports, all at your fingertips. Choosing the right trading account is crucial for a seamless and rewarding investment experience. Section 4. Understanding the basics, shares, and the stock market. Now that you have a grasp of the essential accounts required for stock market investing, let's dive into the fundamentals of shares and how the stock market operates. At its core, a share represents a unit of ownership in a publicly listed company. When you buy a share of a company, you're essentially becoming a part owner, entitled to a portion of its profits and voting rights in shareholder meetings. Various factors influence these forces, including company performance, industry trends, economic outlook, and investor sentiment. Stepping into the world of stock market investing can feel like learning a new language, filled with unfamiliar terms and acronyms. But fear not, for with a little guidance, you can easily decode this financial jargon and navigate the market with confidence. Let's start with the basics. Shares, also known as stocks, represent ownership units in a company. Owning shares means owning a portion of that company, and as the company prospers, so does the value of your shares. Understanding these fluctuations is key to successful investing, and that's where the concepts of bull and bear markets come into play. Imagine a bull, strong and charging forward with its horns. That's the image of a bull market, characterized by rising stock prices, investor optimism, and economic growth. Companies are typically performing well, profits are rising, and investors are eager to buy shares, driving prices higher. On the other hand, envision a bear, lumbering downward with its weight. That's the essence of a bear market, marked by falling stock prices, investor pessimism, and economic slowdown. Understanding these market cycles is crucial for investors. During a bull market, the strategy might be to buy and hold, riding the upward trend. In the vast ocean of the stock market, with thousands of companies listed, how do we gauge the overall health and direction of the market? That's where indices come in, acting as barometers of market performance. An index tracks the performance of a group of stocks, representing a particular market or sector. Think of it as a representative sample, providing a snapshot of the broader market trend. Some of the most widely followed indices include the S&P 500, which tracks the performance of 500 large-cap U.S. companies, and the Dow Jones Industrial Average, comprising 30 blue-chip U.S. companies. These indices are not merely abstract numbers. They reflect the collective sentiment and performance of a significant portion of the market. Understanding indices is an essential step towards becoming a savvy stock market investor. Unveiling the power of analysis, your guide to informed investing. Venturing into the stock market without a solid understanding of analysis is like navigating a maze blindfolded. To make informed investment decisions, you need to become a detective of sorts, carefully examining the clues that can reveal a company's true worth and potential for growth. There are two primary approaches to analyzing stocks: fundamental analysis and technical analysis. Fundamental analysis delves into the nitty-gritty of a company's financial health, management quality, and competitive position. Fundamental analysis, peering into a company's soul. Imagine being able to assess a company's true value beyond the hype and market noise. It involves scrutinizing a company's financial statements, understanding its business model, evaluating its management team, and analyzing its industry dynamics. Key financial ratios, such as price to earnings, PE, return on equity, ROE, and debt to equity, provide valuable insights into a company's profitability, efficiency, and financial health. Fundamental analysis empowers you to make informed decisions based on a company's intrinsic value, rather than relying solely on market sentiment or speculation. Technical analysis, deciphering the language of charts. While fundamental analysis focuses on a company's intrinsic value, technical analysis delves into the realm of market psychology and price patterns. It's based on the premise that history often repeats itself in the stock market, and that by studying historical price movements and trading volume, we can identify patterns that may indicate future price direction. Technical analysts rely on charts, indicators, and oscillators to decipher the language of the market. Technical indicators, such as the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, provide insights into momentum, overbought or oversold conditions, and potential trend reversals. Diversification is often referred to as the only free lunch in investing. This strategy involves spreading your investments across various asset classes, industries, and geographic regions to reduce risk. By diversifying, you can mitigate the impact of poor performance in one area by balancing it with better performance in another. For instance, if you invest all your money in tech stocks, a downturn in the technology sector could severely affect your portfolio. However, if you diversify your investments across technology, healthcare, consumer goods, and other sectors, the impact of a downturn in one sector is cushioned by potential gains in others. Diversification doesn't just apply to different sectors, it also means investing in different types of assets. Stop-loss orders are a crucial tool for managing risk in the stock market. A stop-loss order is an order placed with a broker to buy or sell once the stock reaches a certain price. It's designed to limit an investor's loss on a security position. Setting a stop-loss order helps investors avoid the emotional decision-making that often accompanies falling stock prices. However, it's important to set your stop-loss orders wisely. A common strategy is to set stop-loss orders at key support levels or at a percentage below the purchase price that you're comfortable with. Position sizing is critical in stock market investing. It refers to the amount of capital you allocate to an investment. The 1% rule suggests risking only 1% of your capital on any trade. This ensures no single loss can significantly impact your portfolio. High volatility stocks should have smaller position sizes. Thoughtful position sizing balances your portfolio and protects it. Venturing beyond traditional stocks and bonds, we enter the complex world of derivatives. These instruments derive value from underlying assets like stocks, bonds, or commodities. They are financial contracts for speculation and hedging. Speculators amplify returns, while hedgers mitigate risk. Options and futures are common derivatives. Options give rights. Futures obligate transactions. Derivatives carry significant risks and rewards. Seek expert advice before delving into derivatives. Section 2. Hedging, shielding your portfolio from uncertainty. In financial markets, hedging is like wearing a seatbelt while driving. It's a strategy to protect your portfolio from potential losses. Hedging cushions your investments from unexpected market downturns. It involves taking an offsetting position in a related asset. For example, buying put options to hedge a stock position. Put options limit your downside risk if the stock price falls. Hedging strategies can be tailored to specific investment goals. Implementing hedging strategies helps protect your portfolio from potential losses. Section 3. Quantitative easing, a glimpse into central bank policy. Quantitative easing, or QE, is a powerful tool used by central banks to stimulate economic growth. It injects liquidity into the financial system, boosting lending and spending. Central banks buy long-term government bonds or other assets. This lowers interest rates, making borrowing cheaper. It can also raise asset prices like stocks and real estate. However, QE carries risks like inflation and asset bubbles. Understanding QE is crucial for investors as it impacts asset classes. Section 1. Embark on your investment journey. As we conclude this beginner's guide to stock market investing, remember that the most important step is to simply begin. Start by opening your demat and trading accounts, choosing a reputable broker that aligns with your investment goals and risk tolerance. Begin with a small investment amount, gradually increasing your exposure as you gain experience and confidence. Don't be afraid to make mistakes. They are valuable learning opportunities. Embrace the journey of continuous learning, staying informed about market trends, economic indicators, and company news. Utilize the plethora of resources available to investors, including financial websites, investment blogs, and educational platforms. Remember, the stock market is a marathon, not a sprint. Patience, discipline, and a long-term perspective are essential for success. Avoid emotional decision-making, chasing quick profits, or timing the market. Instead, focus on building a diversified portfolio, managing risk effectively, and staying committed to your investment goals. Section 2. A journey of learning and growth. Investing in the stock market is not merely about financial returns, it's a journey of learning, growth, and empowerment. As you delve deeper into the world of investing, you'll develop valuable skills such as financial literacy, analytical thinking, and risk management. Embrace the challenges and rewards that come with being an investor. Celebrate your successes, learn from your setbacks, and never stop seeking knowledge. The stock market is a dynamic and ever-evolving landscape, offering endless opportunities for those willing to adapt and grow. Remember, investing is a lifelong pursuit, and the knowledge and experience you gain along the way will serve you well beyond the realm of finance. So, take that first step, embark on your investment journey, and watch your financial future blossom.